This is the M&A panel. We have a different title, a cuter title this year, but it's basically the M&A panel. And there's always something interesting to say about M&A. And I think this year, if I were to phrase what the kind of conundrum is, everybody sees that things are cheaper. Prices are very low. People are in distress. And everybody assumes that that's what's going to drive M&A activity. And so the question is, how come there isn't more M&A activity? Because in fact, if we look around, not much has really happened yet. Now, there's been the BG Shell transaction, and we're fortunate because Alastair Maxwell on the panel is with Goldman Sachs and is involved in that transaction. And I think Alastair either told me he could or couldn't comment on Goldman. Which was it, Alastair?
You know what I said, Bob. I said I could not.
So we have to not ask Alastair about BG, but it's serious that is one of the only transactions that's happened. And so people are wondering why is that? And the sort of simple response, the stock response that people give is, well, because buyers and sellers haven't been able to reach consensus yet on a price level. And that as soon as that happens, as soon as buyers and sellers are able to reach consensus, then everything's going to start happening. So in advance of that, the question for this panel, or the topic for this panel, is what is going to drive that consensus? And that's where we get to this idea of drilling on Wall Street, because Wall Street provides a kind of relatively simplistic view of the way people are putting value on barrels, and barrels relative to what it would cost an industry participant to develop the equivalent number of barrels in terms of finding and development costs. So it's quite a normal practice to compare F&D costs in the industry with what you can acquire barrels in the market, and if it's a lot cheaper, then you should go off and buy, assets or companies, and that's another nuance. We're talking about buying companies on Wall Street. You're not buying assets, but that's a sort of link between, the organic growth, asset acquisition, and then finally corporate acquisition. So I think if we can use this time to try to get some views as to the facts about where the numbers are, where the market is actually trading, and by implication clearing, if that's possible, some of these transactions. Maybe we can identify at least the elements around which there has to, a consensus has to emerge. And what we're going to do is, we've been talking a lot about how to organize ourselves. So first we have two bankers, and the bankers are going to give you their view, and we're going to have a first, as far as I know. The bankers are going to present jointly. So they've put together some slides, and they're going to go through their own slides themselves, and we'll see how that works. But that'll be a first if it works. But we're going to get those facts down, and then Poppy Allonby will talk about, as an owner of these assets, hear how she reacts to what the market seems to be telling us. As an owner in the market, she may be able to describe to us exactly what it is that she's thinking about, whether she recognizes any of these numbers or not. And then finally, Christof Ruhl has the role of providing a bit of a sanity check. I mean, he, as an economist and a macroeconomist, has a kind of broader view of the complexity of some of these issues surrounding the market and the inputs that have to go into it. So Christof's job is to kind of act as a bit of a wrap-up and sanity check this, tell us whether any of this makes sense, if it's what he would expect given the macro view that he has, and then maybe some suggestions as to how that either the market has it right or wrong and what needs to be corrected. And then after that, we can go to questions. But equally, because I think we're going to be fairly informal with particularly the bankers starting off, we're going to encourage the panel to jump in if anything strikes them as particularly discordant or what they want to make a comment on. But having said all of that, if we could ask Alastair to begin for the bankers.
So thank you, Bob. Good afternoon, everybody. Very nice to be here. So we start off with a couple of charts, and everything in the industry always seems to start off with what's the price. And of course, part of the answer is Mr. Tillerson was saying yesterday is nobody knows. But we've got two charts here, one of which on the left-hand side shows the forward curve earlier on in the year, and the other shows the forward curve today, which not surprisingly is the bottom line. And the front end is down, $15 odd, and the back end is down roughly $10. And of course, the question is, does the forward curve matter? And it matters in some senses because it's a reference point. It matters in the sense that if you want to hedge the oil price or the gas price in the context of an M&A transaction, then that's what you're hedging against. Other than that, it's relatively unimportant. I remember Bob and I were talking earlier on about a conference that used to be run, or a seminar that used to be run by Robert Mabro, the late Robert Mabro, in Oxford every year, and he used to ask everybody at the end of a 10-day seminar what do they think the oil price was going to be in 5 years' time. And he then plotted that over 25 years and 30 years, and it was always somewhere around the spot price. So the answer is that everybody's views on the oil price all get bunched around where the spot price is at that point in time. And of course, the forward curve is sometimes useful for sellers when the forward curve is above where people's views of long-run marginal cost is, and sometimes it's useful for buyers, probably in today's environment, where it's below what sellers would like to think the long-term marginal cost is. On the right-hand side, we show consensus, and I think there's the interesting thing about consensus is, first of all, it hasn't really changed since earlier in the year, particularly at the back end. It's hardly changed at all. But I think if you can just see on the slide, there's a shaded area, and the shaded area, when you get out to 2019, 2020, it goes all the way from somewhere around $55 at the bottom to about $105 at the top. And I think what that tells me is that people really don't know where the oil price is going to be in 5 or 6 years' time. And therefore, this makes it much more difficult in terms of trying to narrow the gap in terms of where you should be thinking about long-term oil prices in an M&A context. What I can tell you, what we hear about companies in terms of their own businesses and their own activities, I think people now widely expect it will be lower for longer, hopefully less low and less long, but it will be lower for longer. And I think everybody seems to be saying, I'd like to get my own business in shape in order to be able to cover my outgoings, pay my dividend by somewhere around $60 by somewhere around 2017 at the latest. And that seems to be the broad macro framework within which everybody is working. And of course, one of the correlations of that is that any acquisitions that you may be looking at need to be competitive with your own portfolio within that framework, and that's one of the biggest challenges. Just very briefly, this is the Goldman view of what the supply curve, marginal cost supply curve looks like. You can see you go out to somewhere around 30 million barrels a day of incremental supply at somewhere around $60 odd. I know Michael has a similar chart that UBS has put together, and it may be $10 higher than that. But certainly there's a view that at least with marginal costs being one reference point for long-term prices in an M&A context, again, in that sense of competing with internal organic opportunities, somewhere in that $60, $70 range seems to be roughly where the market is at.
Thanks, Alastair. Is this live? It is. Excuse us for the charts, by the way, but at least you only have one from the two of us rather than one from each of us in each topic. This chart illustrates 3 lines from the top, on the right-hand side from top to bottom, F&D costs on a 2-year average basis trailing for what we call the global IOC group. Next, the blue line is M&A value per approved barrel observed. And finally, the public market valuation on approved barrel basis. The point here, I mean, there's more than one way to interpret every data set, I suppose, but one could look at this and say, well, the larger companies that are investing so much in F&D should stop that and acquire companies or assets in the M&A market for assets or corporations that are trading at valuations that are half or less than half, let's say half for argument's sake, after factoring in a premium of the F&D cost per barrel, which is, I think, a valid interpretation. A different interpretation would be to just stop the spending, period, and do something else with the money, whether balance sheet repair or payouts to shareholders.
Mike, could you just, for the benefit of the audience who might not get F&D costs, just explain what goes into that? And as you say, it's a 2-year rolling average. What does that actually represent?
Okay, so it is finding and development costs per proved barrel. So and we use averages here because the year-to-year data can be very jumpy on a per company basis. It tends to average out across companies when you include enough companies, but that's why it's not a straight 1 year, because of the volatility involved. So it's how much a company invests in exploration and development, and then how many proved barrels that investment yields.
Good.
That's a numerator thing. Thanks, Bob. The funny thing is, three of us used to work together, so it makes us easier than perhaps it would otherwise be. So motivations for pursuing M&A in that context. One, if there's a view, and we'll get to this, that the market is somehow mispricing a company or an asset or a country's assets. That could be as a result, by the way, of a proprietary view on a set of assets or a basin or a company. Two would be there's some synergy value, whether development, operating, G&A, tax, any kind of synergy. I think the financial synergy argument's a poor one, by the way, for adding value as a buyer to the target's assets or to the target company shareholders. And third would be as a way to high grade the portfolio, which Poppy can comment on that third motivation and whether it's an appropriate one from a perspective of an investor. These always have to be considered relative to the alternative uses of that capital, especially if we're talking about cash, which could include, as said, buying back stock, prepaying or repaying debt, or paying a higher dividend. So we've seen in the current market, we expect to see, we can spin forward, stock for stock corporate M&A as opposed to cash M&A. One, because the cost of capital for the industry has increased in this cycle, and two, because the risks inherent in that format are more manageable for the buyer. Finally, the seller selling for cash at the trough, which I'm more in the bullish camp, so I consider this period of time the trough in this cycle, is not something that someone that is not in financial distress would care to do. So next layer down on F&D, this shows on the left the US, and on the right the world ex-US. And you can see very quickly that this relationship between the F&D cost and the values in both the M&A market and the public market is actually much less drastic than on the previous page. And the US and Canada are, of course, the two countries where arguably the number of candidates for acquisition is the largest. There on the right, you see that the relationship's a little bit different, but also the candidate set is more compressed. Next page, this is Wood Mackenzie data, but basically, sorry for the amount of information on this page, but basically you see very quickly, focusing on the bars first, and this just depicts M&A activity, M&A volumes, that in every downward oil price cycle, the number of transactions goes down significantly, which is logical. It's terrible for bankers, by the way, but it is, but it is something that happens in every cycle. And it's a function of two things: a shift in the cost of capital, and lack of visibility on what the future looks like. Despite that, what's interesting is it appears that basically since the left-hand side of the chart now, mid-07, even to today, the red line, which depicts the implied long-term oil price of those deals that do happen, basically hovers around $80 Brent long-term, which is an interesting thing in the context of the conversations we've had in this forum over the last 36 hours or so.
I think the only other thing I'd say to that, Michael, is that's obviously WoodMac data, and it depends a lot on what you've got in there, factored in there for future cost in terms of what the oil price required is to end up at, to get to the deal value. So here we've got even more data on this slide, but taking this into the public market context and thinking about M&A or M&A public companies as M&A targets. So we've shown on the left-hand side here what's happened to companies' share prices. This is a series of independent E&P companies, all based in Europe, or most of them based in Europe, one or two exceptions like Cosmos, but with assets outside North America. And the orange line is the one to focus on, which is what's happened to their share prices over the last year. And you can see that stock prices are down anything from sort of in the very best instance, which is Lundin, about 15%, all the way down to pretty much 90%. And on the right-hand side, we've got a heat map, and green means companies that are reasonably valued. Red means companies that are less reasonably valued. And I think that it's the other way around. Green is companies which are trading well, and red is companies which are trading more poorly. And you'll see as you go down, there's one characteristic that unites all the companies down at the bottom of the table, which is the companies with higher leverage are the ones whose share prices have performed worse and who are valued at lower levels today. And leverage in a commodity business, particularly where you're unhedged, and particularly where you have assets which are relatively high on the cost curve, of course, is a very dangerous place to be. And so it looks as though things ought to be really cheap because share prices are down 50-60%. But there's a couple of problems. The first problem is the leverage question, because if you're looking at these companies as an acquirer, you're looking at buying 100% of the company, 100% of the assets, and you're having to pay 100 cents on the dollar for the debt. And therefore, if you think about this in terms of asset value and enterprise value, which of course go together, the share price may be down 50-60%, but the enterprise value, if you're 50% levered, is only down by 25%. And so it's still difficult making the maths add up. And in particular, if you buy one of these companies and let's say you're a private equity shop and you need to refinance the debt, almost certainly you're going to be able to refinance less debt at a higher cost than the company has today. And again, it just makes the maths harder. The second question, of course, is what's in net asset value. And I'm not going to spend any time on that, but of course beauty is very much in the eye of the beholder in terms of how people think about prices, about costs, and about risking. And the last thing, which is a point that Michael made, is how many of these companies own assets that in the context of the portfolios of the large companies who have the balance sheets which are able to take advantage of today's market conditions. How many of those assets are going to compete for capital in a very capital-constrained world in the context of those companies' portfolios?
Now,
Nice.
Michael, we need to give Poppy a chance here.
At a time. Thank you, Bob.
Yep.
But this is the U.S. picture is very much the same in terms of the backward-looking share price performance, which I think Alastair captured that comment well. The next page is I'd focus on the right-hand side. I think it's interesting. This is a UBS view, but I think the Goldman view is quite similar, although it's probably lower on the U.S. E&Ps. What is the long-term Brent price? There's a $5 differential between Brent and WTI in here for the U.S. names. That is implied by the current market valuations of each group. And basically, you can see that the range is essentially the forward curve and the broker consensus forecast. And further, if someone were to try and buy a company which requires a change of control premium, that means that we are talking about 80, 90, or with synergies and development value, et cetera, maybe a little bit lower than that, but a high price based or relative to the oil price views have been expressed over the last 36 hours or so in this forum. So, in the absence of a compelling motivation of the list that we touched on earlier, doesn't feel like we're actually lined up for a wave of high premium cash M&A with more probably stock-led, lower premium M&A. And our conversation here is focused on the upstream, but I think the comments also are relevant for the downstream and the service sector. The last slide's about liquidity, but I think Alastair's comments captured the point about leverage and liquidity. The only point I would add is that the expectations, depending on the company or board, that may exist around an appropriate premium for a change of control transaction may not be realistic if the company has an unfunded business plan. Because let's say NAV is a function of investing capital in excess of cash flow for a period of time. That means they have to obtain that capital from somewhere. And if they cannot obtain it from the debt market because there's no debt capacity, and they're selling equity at a $1 or $2 per recoverable barrel type multiple, then actually the premium expectations should probably be lower. But that getting to that point is actually not an easy thing for anyone to do. Sorry for the time.
All right. Now, Poppy, do you recognize any of that? You're an owner of these assets, and we've heard about the numbers and the finding and development costs and the oil price baked in. Did you know you were doing that, or was it news to you?
Well, let me make a few comments maybe about how we're seeing the market and reflect on some of the things you've said. And I think that when I personally look at the market, we focus a lot on returns, because to the points that you made, trying to work out what oil prices baked into these stocks really depends a lot on what your cost assumptions are. So they're sensitive to both, but returns should hopefully capture both of those. So I'd echo the comments actually from the earlier panel before lunch. As at Blackrock, when we look at positioning and we look at sentiment, it looks like this sector, from an equity perspective, is very out of favour. Not only is sentiment low, but it looks like it's a consensus underweight in equity markets. And it's pretty common for investors to think, not every investor, but for a lot of investors to think today that oil prices will stay low for a long period of time. And perhaps that's not surprising, really, given what we've seen in terms of oil price moves over the last year. But what is surprising, or what may surprise you, is that this repositioning of the market didn't start a year ago. It started 4 years ago. So long before we saw the oil price collapse, sentiment was falling for energy. And really the reason for this, in my opinion at least, is because industry returns were under pressure. And this is where I'll try and get back to returns and some of the comments you made. And if you look on average at the industry, and clearly this is average numbers, industry returns have been falling since 2012. Not since 2014, but since 2012. And one of your slides actually made the point, you didn't make the point actually, but one of your slides made the point looking at F&D costs, because you were making the point that there's this difference in F&D cost about what is implied. But when I looked at that chart, one of the other things that stood out was how much F&D costs have risen. And my eyesight isn't great, but it looked like they had tripled in the time period that you had up there. So returns have been under pressure really because costs, whether that be F&D costs or other costs, have been rising and really, to a degree, you could argue, got a bit out of control over the last few years. And I'll just make a few more points on returns, and I may have a slide. Brilliant. So I've only got one slide, and I'll just talk to these two graphs. The chart on the left is looking at some data from Bernstein, and this is actually looking at returns for the industry over 100 years. And I should just explain this. This isn't the numbers here aren't the actual return on capital employed. That's actually a deviation from the mean. So over time, over 100 years, the industry as a whole, and of course there are exceptions, has earned roughly a cost of capital rate of return. And what this chart does is it says that's the kind of average return, that's zero, and then looks at standard the deviation away from long-term cost of capital returns. And first of all, you can see that point I was making, that returns had been falling over the last couple of years. But also there are a few other interesting things, I think, in this chart. The first is just to recognize that over time and generally, as you would probably expect in a commodity business, this is a cost of capital business, give or take, and that over time you have periods where the industry over-earns and periods where it under-earns its cost of capital, but overall it mean reverts. And so far so obvious, I suppose, but what's interesting from an investment perspective and from my perspective is that there are periods in time where the market, the equity market, does not assume, does not price the equities as if the returns will mean revert. It prices them as if they'll be good forever or bad forever. And I'd say we're in the latter environment at the moment. The market is incredibly pessimistic about the outlook for these companies and their ability to generate reasonable returns. And if we now turn to the second chart on the right-hand side, that kind of hopefully I can talk through the evidence behind that view. And this is a chart. I think there's a title. Oh, no, I better read it out, and there's no title. This is a price-to-book value chart, and it's looking at energy equities versus broader market. So this is a comparative relative valuation chart, and looking at price-to-book value. Now, if the energy equities were trading at 1, that would imply that the energy market generates the same kind of a market-type return. Over the last 25 years, the sector's traded at a discount to that, implying it's a cost of capital business. But what you can see there is the disconnect between energy equity valuations in the broader market is really at extreme levels of pessimism. You're talking at a sector that is trading at half the value of the broader market on that metric. And that looks to me a little extreme, to say the least, especially if, as we've heard over the last couple of days, the industry is taking action to improve returns through cost reduction, et cetera, to hopefully improve the return picture that we see on the left-hand side. And just also from a historical perspective, you can only see 2 other instances on that chart, on the right-hand side, when valuations have looked so extremely low relative to the broader market. And there were the other 2 big oil crises, and in each case you had a positive re-rating in the years that followed, as effectively returns didn't go supernormal but started to improve. So I think from my perspective this hasn't gone unnoticed, and certainly at Blackrock we're seeing more and more interest in our energy product, and we've started to see some of the sell side, some of your colleagues possibly, start to upgrade their views on the sector given the extreme positioning and extreme valuations that we see. I was just going to make one comment, if I may, on your slide, which was talking about the futures curve and what kind of numbers to use. We think the futures curve is not an accurate predictor of returns, and just to check our view, I ran the numbers, and over the last 20 years, the futures curve has accurately, and when I say accurately, I mean within 10%, so not exactly accurate, but it's got it right, roughly 15% of the time. So it hasn't been an accurate predictor, but it is something that we all look at, no doubt. And our view is that, over time, the evidence suggests that prices migrate towards marginal cost, which itself moves up and down. And clearly at this point today, there appears to be a real misalignment between where the forward curve is and where the cost curve is. And so I see that as unsustainable, and either costs have to fall further, even more, or prices have to rise.
Okay, so now it's as confusing as before, because on the one hand, the finding and development costs are clearly cheaper in the market, and we're worried about costs, and people are spending all this money to develop barrels, but it's right in front of you. You can buy them in the market a lot cheaper. So assuming there'd be sellers, and Poppy's just told us that the sector is out of favor, to say the least, it sounds as though, if you came forward with an offer, people would bite your hand off. So why isn't that happening? That's a simplistic view. There's obviously more complexity to that, and Christof, I hope, will add some of that or explain.
Adding to complexity.
Well, or we're being overly simplistic in looking at these measures, or what are we missing?
I think
or not.
The first thing, well, let me check the cheap shots first. I think.
Yeah, good.
When you have bankers talking, you can always rely on them for getting history. And so the first thing which would have helped is when you actually go back to the last big wave of mergers and acquisitions, which was in the 90s, when there was a market consensus and the low price and the oil price being very low for a very long time in the future, which promptly proved wrong. And when you had these mergers and acquisitions and the prices subsequently picked up, there was a big question on whether really any value was created or whether all that happened too late. That would have been an interesting perspective. Your thing just went back to 2006, which is exactly when nothing happened in terms of. The second, this is not a cheap shot, but it's very actually a simple point, but very important point. I would like to meet follows up from Poppy. This is terribly important. And I used to work in the oil industry, and we had a terrible time always to explain to the upstream guys that they actually also live in a cyclical, or if you want, in a margin business. And this is about revenues. Very simple. In the oil industry, cost follows prices, always, up and down, and it's a causal relationship. And it's something which is straightforward, but not very well understood. And I think what we are seeing right now was a big, whether you look at the microscope in the US or you step back and you look at the conventional global industry, is a very rapid decline in prices and costs just about to catch up. And these guys just haven't, not yet, unfortunately, cut enough of the fat which is there to cut. We know actually about this. It's a cost follow prices with a lag. It's much shorter in the US. 12 to 18 months where you have a much better infrastructure. It's much longer for a global relationship. It's longer offshore than onshore, but that's the kind of part of the cycle in which we're in. So that's the cheap shots. But I think what I want to say basically to the initial question, so why is all these evaluations so low and mergers acquisitions not forthcoming? The answer is, I think you've given correctly, is that nobody really is sure at this point what is going on. Which, if history is any guide, would probably be a good point in time for mergers and acquisitions, but they will have to wait until people think they know. And so this kind of uncertainty, I think, has at least two dimensions. One is the actual oil price developments, the markets, where is it going? And the other one, when you step back, is the bigger sort of macroeconomic picture and the relationship between the decline in oil prices and a pretty still dismal macroeconomic picture. And so I just wanted to sum up those two things to increase the confusion before we go in the discussion. On the oil price picture, we have heard a lot the last few days. And, it's a complex thing. We know two things. We know where it all started. After 3 years, from beginning of 2011 to beginning of spring of 2014, of the highest oil prices ever and the most stable oil prices ever. All of a sudden they came down just at the point in time when everybody would have agreed that they are stable for reasons which indicate an underlying stability in the system. Of course, that was not true. What happened behind these seemingly stable oil prices, most stable prices ever, was a rapid growth in US unconventional and Canadian unconventional production on the one side, massive supply disruptions in North Africa and the Middle East on the other. And if you overlay these tools, and I've done that, it's an almost one-to-one match, almost barrel for barrel, the increases, which were of historic proportions in the US, canceled out, offset by the supply disruptions in North Africa and the Middle East. It's one of the most funny supply stories in any economic area, I think, of the last few decades, because this is, of course, an accidental match. The Libyan civil war had very little to do with oil men in the US pushing forward production, no matter what conspiracy theorists like to link the two. So the question was always, the system is going to fall off a cliff, which way? Either the tremendous growth in the US would eventually overcome these supply disruptions, or something really very bad would have had to happen in oil-producing countries to keep up with the supply growth by increasing disruptions. And eventually it was a bit of a return of Libyan production, an uptick in Russia, and the system went off a cliff, and we have a situation of a clear supply overhang. We know that this uncertainty will be removed eventually only once global demand is strong enough or the change in demand is strong enough to keep up with both an increase in shale production and an increase in whatever OPEC decides to produce at that point in time. This is a few years away, and we don't know when this will happen. Meanwhile, when prices came down, OPEC, against expectations, and I think correctly from their point of view, decided not to stabilize prices, not to cut beyond these existing listeners, just to step back in order to avoid losing market share. And so that's the situation where we are now. Now you look around and there's at least 4 moving pieces at the same time, giving ground to investors being careful with M&As. One of them is, of course, the question of how resilient is shale oil in this game of bringing prices down and reducing US market share. We have heard yesterday morning, I think, people saying that it's just like other conventional sources, it's not resilient at all. I think this is a question where the jury is still out, and it's probably the most important of all these questions. Prices have gone down 50%, and surprise, surprise, the rig count has fallen, and it would be a real surprise if production wouldn't decline. Of course, production in the US will decline in response to that. We know that the lag times are about a year, and so in this case, it seems to be more like 6 to 8 months, but production will decline. The real litmus test comes what happens next. If some of these analysts are right and we see prices ticking up by the end of this year, say 60, 70, maybe a little higher dollars, how quickly is shale production coming back, and how flexible is it really in responding? Are we talking months, or are we talking longer, and are we talking big price differences or small ones? The situation has even given rise to a new entry in the dictionary of the English language, in the frag log. The fact that many people, many producers, when rig prices came down, started to continue drilling, but didn't prepare the wells, didn't frack them yet. And depending whom you ask, there's between 3,200, 3,700 wells, translates into roughly maybe 500,000 barrels per day, ready to go if prices pick up, which could reduce that time even further. So you have the old, meanwhile, of course, you also have cuts in capital expenditure and conventional. Also, you have the old 7-10-year cycle, and this high-frequency thing in the middle by shale, which has never happened before, and nobody knows how it ends. Second, you have inventories, not much discussed, but important, because onshore inventories is a hard thing to get numbers by, but they seem to be getting crowded. The moment in time inventories have to migrate offshore, you would have to see an increase of north of $20, people saying, costs. That means a price drop and an increase in contango matching that, and you would have a short-term decline in prices, which would hit shale producers and others and OPEC even harder. The third one is demand, already responding very nicely. Many people haven't looked at this, but demand figures this year may be about 1.8 million barrels per day, which compares to, I think, less than 1 million for last year. It's quite an exchange. With interesting and uncertainties and facets in that as well, you look at China. People say, oh, China is going to slow down. That's bad for oil demand. We know that China is slowing down. We know why, because it has to, as the Chinese say, rebalance its economy from an over-reliance on investments towards more domestic consumption, more services, and so on. When you now look at it, this will affect energies in different fuels in different ways. This will hit coal hard if growth comes down. It will hit probably diesel demand, because that's heavy-duty transport and related to GDP growth, but not necessarily oil demand, because oil demand is contingent on income. And when you have a structural shift in an economy where growth slows down, but a larger proportion is spent for consumption of households, then you would expect oil demand to go up. And what do we see in the numbers? I think Adam or Spencer, somebody showed a slide yesterday. Steady diesel growth indicating that economic growth is probably much lower than the GDP figures, something which I think is true. And a rise in oil consumption, not necessarily only a short-term price response, but indication of this structural shift in the Chinese economy. So not even the demand projections are very certain. And then the last one, of course, is next to the shale reaction. When you look at the history of this supply shock, as people say, the last item of these moving parts is OPEC's reaction. Will OPEC blink at some point, or will it not? And again, the jury is out of this. So when I look at this interplay of things, then I know we will have to wait for seeing what actually happens to shale in a response to an uptick in prices. We'll have to wait in order to have a better gauge on demand, when demand is strong enough to pick up shale supply increases plus OPEC supply increases. And then we have to step back and say at which level of prices would OPEC like to adjust its production. I think that is the big picture. And against, coming back to the theme, against that background, I think it's hard to make decisions other than what you have indicated to say, okay, we have an valuation problem here and either we set it out or we cut costs. But it's hard to ask the industry to make an M&A decision against that background. Now, if I have 2 more minutes.
Sure.
There's something else going on, which is really interesting. There's a lot of, when I say nonsense, which has fallen by the wayside in the wake of this adjustment after these seemingly stable 3 to 4 years. And peak oil has been always mentioned, but of course that's gone. With it, also the hypothesis that speculation or financial investment drives oil prices is largely not mentioned anymore, even though it may, in times of extreme changes, be more true than in times of stability. But one of the funny things which happened is that for a year now, you got, and you're absolutely right on this, you got permanently adjusted predictions from all these investment houses on lower and lower oil prices. And then you got all these nice write-ups, you know, winners and losers, all exporters lose, all importers win. And then you got calculations to the third degree behind the comma, how that translates into GDP growth. At the same time, but in different departments of the very same investment houses, you had statistical departments busy downgrading GDP projections all over the globe. The IMF is the best example. Since July 2014, they permanently downgraded their oil price forecast, probably in line with the forward curve. And here I have to agree with you again. It's just a thing which moves with spot prices. It's just a measure of our ignorance, nothing else. So you have these people downgrading oil price forecasts and at the same time downgrading GDP growth forecast. And I think that is an interesting question. So what has changed, or why is that these lower oil prices have not given even a boost to optimism, not even mentioning real numbers in terms of global economic growth? So, and when you trace that, again, you come to 3 or 4, let me make 4 brief points on that, which give you a sense from an energy perspective of the fundamental underlying sort of uncertainty on the macro side. Now we're sitting here and really we don't know, is the Fed going to raise before the year end or do we see QE4? You know, that's kind of, so this theme. Now, the first point of why this translation, you know, lower oil prices, stronger demand, and we know what the future brings, doesn't work, is that, of course, it's not only the oil prices which are moving. There's other relative prices which are changing, and the one I would like to point out is the dollar. We had a 34% improvement in real trade-weighted dollar increase since 2011. That's not much off from the change in the oil price. And at the same time as these investment houses produce their winner and loser outlooks for oil prices, different departments produce their winner and loser outlook for dollar appreciation. If you put those two together, you get a very much colorful picture. You know, you get, it's no longer India and China and Europe are all winning from low oil prices. It's India winning from low oil prices and from a flexible exchange rate, and China losing from a fixed exchange rate as long as they peg it, and winning from a low oil price. Same on the producer side. It's no longer Russia and Saudi Arabia both losing. It's Russia getting less currency revenues, hard currency revenues, but it's flexible exchange rate collapsing. So they still don't run the fiscal deficit without much domestic cuts because this translates now into a higher ruble amount. Whereas in Saudi Arabia, you burn through cash reserves very fast with a fixed exchange rate. So the fact is not only the relative price of oil which moves, but other prices is one which blocks this simple translation. The other one relates more to a macro theme and is an interesting thing. It's deleveraging. When you think of it, a decline in oil prices is a perfect zero-sum game. Producers lose, consumers win. Exactly the same amount of money. So the hypothesis that lower oil prices are good for the economy always rests on the assumption that these investments, which will be cut in some faraway places and then translate into some Korean steel mill, carry a lower propensity to increase global GDP than the consumption, than the gains made by consumers who drive more and buy more cars and all that. Right? Now, that transmission mechanism will be blocked if lower oil prices don't translate into more consumption demand, which is the case when you deleverage, when you pay debt instead. We have seen household debt in the US going down from 98 to 78% over the last few years since before the crisis. And we see that in Europe or elsewhere, if the consumer doesn't buy, then the government doesn't step in either because they also have to repay debt. So that blocks it. But more interestingly, the world also has changed in a structural fashion. last time oil prices came down and these calculations were run, you had a pretty strong geographic separation of where the oil was produced and where it was consumed. Now we've seen increasingly large importers in oil-consuming countries producing oil themselves. The key, of course, is the US, where oil dependency, so the amount of oil they consume which is produced at home, has gone from 33% to 61% since 2006, I think. In the last few years, almost doubled. But there's Canada, there's to some extent Brazil. And then you have a different phenomenon, because now it's no longer Abu Dhabi or a BP platform somewhere in Africa, which has to cut investment while consumers in the US and Europe benefit. It's production in North Dakota and in Texas and elsewhere being affected and going down. And the nieces and nephews of these people fired there in Florida probably will adjust their propensity to consume slightly differently than it used to be the case. So that is an important thing which is. And then finally, last point, we have, of course, also an acceleration over the years of this continuous trend in lower oil intensity. Oil just has become less important in the world. Since, I'll give you one number only. Compared to 1980, the US consumed 2 million barrels per oil more today than they did in 1980. That's an increase of 12%. Over the same period, GDP increased by 150%, 149 to be precise. That means oil intensity, the share of oil in GDP, has fallen by almost 60% since we last looked at and did these runs. So what I'm trying to say with these examples is that some of these old linkages are broken for good, some are changed, some are just temporarily unaffected. There's a lot of fog on the ground, even from a macroeconomic or from a really sort of not just oil market perspective. And that, again, confirms to me that these investors, which you have looked on in this narrow window of today, may not be, as is bad news for you as bankers, I guess, but they may not be completely mistaken to wait and see a little bit. And what we should expect is just like the 90s. You will see severe cost cutting first, and mergers, acquisitions only when the water is up to here, and then probably not necessarily accompanied by proven creation of value through these activities.
Okay.
Now, did I confuse you more?
Yeah.
Yeah?
Yes.
You asked
Yes.
for it.
So, I mean, a lot of interesting stuff, but I have a feeling that what the audience would like to know, and maybe what I'll do is ask this question and then use that as the basis on which we then, have expand the participation and invite questions. Having said all of that, what do you each think in 2016, are we going to see, I won't say a rash of, a wave of M&A activity, but maybe above average M&A activity? Do you think, yes or no, Alastair, above average M&A activity in 2016?
It depends how you define
No,
average.
yes or no?
I think there will be certainly, I think there'll be more activity in 2016 than there was in 2015, because 2015, for all the reasons we discussed, has been very, very depressed.
Mike, yes or no?
I have nothing to add what Alastair said.
So yes, kind of?
It'll be, no, I think it'll be average. The average for over the long term will be double 2015.
Okay. Average, so not a wave. Poppy?
Okay. I would be surprised to see more M&A. And, from my perspective, whether that's a good or bad thing depends on the deal.
All right, that's fair.
Yes in the US and no globally.
Okay, great. So with that, kind of no and yes in the US, no everywhere else. That's the conclusion behind all the complexity. Questions?
Hello, my name is John Roper from EON Global Commodities. Just in the context of how you've described M&A activity, you have a lot of small cap E&P companies that are struggling, I mean, really, really struggling to find their way forward. Is the alternative just to let them go bust and go into voluntarily liquidation?
Is that me?
Well, why not? I mean,
So, I think, I can't comment about any particular company, but I think when you look at some of the market in the US and Europe, there have been a number of companies, a segment of that market, that have business models that have been reliant on or contingent on access to capital. So whether it be private equity, whether it be listed equity, whether it be loans, whether it be MLPs, whether it be credit, all sorts of capital have had their part to play. And companies have generally, a lot of companies, not everyone, but a segment of the market has generally outspent internally generated cash flow. So, you know, it doesn't answer your question directly, but when we look at the fate of some of those companies and how that kind of plays out and how much money they spend going forward and what happens to those companies, I think, you know, one of the most critical things will be looking at financial markets and those companies' access to capital. Now, from a personal perspective, I was actually quite surprised how much money some companies were able to raise in the first quarter of this year. A lot of companies were able to recapitalize, but some of those deals are underwater today. So if you still held the stock, you'd be losing money. And so, you know, it's unclear as we look forward. You guys will have probably a much better picture than I will about, you know, what the outlook for those companies is and how much capital they have access to. So it's something I will be watching, just like you, in terms of how that evolves.
One additional comment is I think it's very, very rare that it's in the interests of lenders, particularly lending banks, to pull the plug on companies, particularly in an environment where recovery rates are going to be lower by definition, because it's a very poor time to monetize the underlying assets. And so the tendency is always to try to keep things going until you get to a better market in which to work things out.
Anybody else? Yes? Here?
I'm David Howe. I was just a bit surprised by what I've heard from the bankers, or rather what I haven't heard, because the war on the assets of all energy-related companies is really on in a big way now. I mean, you have against you, just to start at the list, the G8, the G20, you have the Governor of the Bank of England, you have Angelina Jolie, you have Bob Geldof, you have Mr. Corbyn, you have the whole celebrity circuit of the entire planet, you have Mr. Jinping some days of the week, you have Mr. Obama. These are fairly considerable figures to be working against the assets of the energy companies. And I'm just a bit surprised there hasn't been any mention of this. I mean, this is against a background anyway of vast glut in oil production, which looks like continuing. Very flat demand, much flatter, I think, from Asia than anyone realizes. So, and this on top of the fact that the oil-producing motor of the Middle East is running at low. So imagine what would be happening if things began to get peaceful in the Middle East. You could be back to the sort of dollars I was dealing with as a young man of $3 a barrel. I mean, and yet you're talking, you haven't even mentioned the stranded assets attack. And it is, I think, wrong, but it's politically very, very powerful and growing all the time, and it's going to wipe out most of your calculations.
So this is the, yeah, please.
That, actually. So as an investor, it's been apparent to me personally for quite a long time that non-financial factors can have a major impact on our investments, both positive and negative. And so considering non-financial factors, you know, is definitely part of my thinking. And in terms of carbon specifically, there was a lot I would like to say, but not much I can say, because we are about to put out a kind of larger, from an investment perspective, we're about to publish a piece talking about some of these issues in terms of risk and opportunity from an investor perspective, long-term investor perspective, and that report will be out in the coming weeks. So I can't preempt that, I'm afraid, but there will be more to come on that.
Yeah, I
from
mean,
Blackrock's perspective.
it's as you say, the non-financial. I mean, I think the linkage you're talking about is actually a financial linkage. The non-financial is the role of investment in hydrocarbon industries as it relates to concern with climate change, and is it something that people should be doing?
It's actually a campaign, because
But then, and then
you
the
don't set
linkage is to
rules.
say that if you don't do something, you'll have stranded assets. So it's kind of linking that way through something that is more.
The last time I looked, it was up to investors to decide whether they
Correct.
hold certain assets or not and how risky they are. And here's a campaign saying you will be in trouble, but not a regulation saying you shouldn't do it. So that's really very bad, I think.
But so a way to answer that is to address the question, is the financial linkage between it's not ideological, but a philosophical point of view, versus is it a legitimate linkage to say that if you aren't careful, that ideological point of view is going to catch up with you and you're going to wind up with stranded assets, and therefore they're going to be uneconomic. And I guess it's not something that we've commented because I'm not sure that there is a consensus that that linkage is necessarily there yet. Is it?
I agree, and I'd say I don't think it is there. I'd say two other things. I'd say the first, sort of building on what Poppy was saying, what's in the share price of a company today, in terms of which resources and reserves, particularly reserves, are being valued, and probably you'll find, depending on the metric you take and the company you take and how you look at the value, are they valuing anything more than the 2P reserves that are on the books of these companies? Stranded assets tend to be in the resource category rather than in the reserve category, and are effectively people getting the resources for free? So are they paying anything for them today? And I think the second thing goes to what we were talking about in terms of the rationale for M&A. And if you have a project pipeline which is high on the cost curve, not economic in today's environment, therefore those assets by definition fall more into the category of under threat over the longer term, and therefore is M&A a way that you can get yourself down the cost curve and build your project pipeline with assets that are going to be economic in today's environment.
So one more question, I think, in the front row. Okay.
Pierre-René Boukis. It was mentioned that if there were to be some substantial M&A activity, it would be mostly in the US and not elsewhere. Do you see it essentially transaction among US company, or do you think some outside non-US could be buyer of a US company or assets? I mean, Japanese, Chinese, let's say for Abu Dhabi, would it make sense to enter at a cheap price in the shale oil, shale gas industry?
I meant both. I mean, small companies, a lot of them leveraged over the years and geared very highly. So I meant activity within the US, but also with outside investors. ADIA doesn't do investments in energy or the Middle East, so we are out, but everybody else would. So yes, it was a reference to the specific situation in the shale industry, non-conventional industry in the US.
I agree that it'll be both within the U.S. market and from outside into the U.S. market.
I think timing is important. I think that in today's environment, I still think there's another leg to go in the US E&P sector. I think there's a disconnect between the macro, which all the slides we saw yesterday said production in the US is falling and may continue to fall if prices stay where they are, and the micro, which is companies saying we can continue to grow at 5, 10, 15% a year. There's a big disconnect between those two, and I think that still has to play out in share prices in the public markets. Therefore, I think in that context, share, as Michael was saying, stock for stock combinations are possible because both companies are equally overvalued, perhaps, if you like, and you're exchanging one overvalued piece of paper for another. I think cash acquisitions much more challenging.
So let me summarize where I think we are. The general perception that everything is cheap and that therefore there should be a lot of M&A, a lot more M&A activity going on than actually is, might not be happening because it's a lot more complicated than we actually think it is, and that's I'm sure that has to be true. But then when we sort of start to project what's going to happen as consensus does develop, and it always does, we've heard from the panel, and I think Robert Mabro's observation that we tend to project the future based on what's happening today might actually be true, because for the most part we're saying there isn't going to be a lot of M&A activity because there isn't, I wonder, because there isn't a lot of M&A activity happening now. Does that mean it's not going to happen in 2016? I think maybe we have to come back to that next year and see who is right. So I think with that, if we could thank the panel, we've, I think, covered the topic pretty thoroughly. Thank you.